Welcome to this week's podcast. My name's Andrew Wilkinson with Interactive Brokers, and I am delighted to have back in the saddle here after, I don't know, almost a year's absence, Tyler Wood. Welcome, Tyler. How are you?
Hey, Andrew. Great to see you. I'm doing very well. Thanks for having me back.
Good. It's been a long and hazardous year for you, I know, and congratulations on the newborn, which happened very recently.
Yeah, I'm
You've come
back. I
back from
highly
back
recommend
surgery too.
a little general anesthesia is the kind of vacation that really brings mental clarity. So an outpatient surgery, it's great. Of course, I do have a newborn, and so net, I'm probably just as foggy as I always am. Nice to get back and chat with you.
We're going to try and make things a little bit clearer now. And just for the benefit of the guests, Tyler Wood is with the Chartered Market Technicians Association, or the CMT, which means he knows how to read a chart very well. And that's what we're going to concentrate on today. We're recording this Wednesday, the 10th of September, and the market is just putting in another all-time high. So that's a great backdrop. You know, when this recording goes out, you never know.
That's right.
Could be the new 52-week low, but we'll deal with that. So, Tyler, you've disappeared off the radar just after the end of the first quarter, when all the fun hit with Liberation Day and the Rose Garden and so on, and then the market just took a huge swoon.
Yeah.
As you get your feet back under the table, give us a sense of how you're seeing the overall health of the stock market.
Yep.
As the markets, particularly on the tech side, but it's both tech and core indices are making new all-time highs. What does it look like to you?
I think that's one of the beauties of trend following investing or momentum investing, or even just using charts, data visualization, is that you can keep things simple. I talk to a lot of smarter folks than I who have this 4-dimensional chess macro strategy, their scenario planning about how the tariffs are going to impact and geopolitical conflicts and all of that. My sleepy Midwestern roots keep things pretty simple, which is to take a look at all of the major indices and just check, are we still trending higher? Is there a series of higher highs and higher lows? Are we above moving averages? And in all technical analysis work, tend to take that top-down approach. So start with, where are we? And my answer is, yes, those trends are largely still intact. We're holding moving averages, all of the volume trend, things like chicken money flow. There's still healthy, constructive evidence that it's not all doomsday, at least not yet, right? So knowing where you are is a very helpful starting point to decide how you're going to react to where you might be going. That doesn't mean that markets are going to trend in a straight line upward and to the right. Certainly, a lot of the analysts that I get to talk to are looking out for some seasonality. The bottom line is that the uptrend is intact. We keep testing, or as we are today, making new all-time highs. And we've had some breadth appreciation, some improving breadth statistics and some broadening of the market that is really helpful. I've read from Bloomberg, over 64% of the Russell 3000 are back above their 200-day moving averages. So that's a healthier backdrop than the narrow leadership that we were worried about earlier in the year.
So I want to jump into the big picture conversation here with yields, bond yields, for a particular reason. Very recently, economic weakness has brought to the fore the idea that the FOMC will resume monetary easing next week, middle of September.
Yep.
And that it's the job of the stock market to discount the future, including lower interest rates. How much of where we are today is predicated on hopes that rates will come down? How does the technical situation look to you for yields across the curve?
I don't think it's a radical view to think that the next move is lower, but it also depends on what your time horizon is. Not knowing every single listener on here, if you're thinking about what's going to happen over the next 5 years, 10 years, if you're a sovereign wealth fund and you're looking out 25 years, I think we're in a rising interest rate environment. We have 40 years of downward trends on the US 10-year, and those broke after a massive V-bottom during the pandemic. But yes, weakening data off of the jobs report, and a couple of folks lost their jobs. Well, we will see that price cut. And I'd say a lot of it is already priced in. Futures in the FX market are already discounting a really high probability of that September cut. Market implied odds are around 90% for a quarter point, 25 basis points. But what the equity tape is reacting to is what the path of cuts might be, and that matters more than will this first cut happen.
So one burning question on everybody's lips is the health of the tech sector today. Narrow leadership for the first, I don't know,
Mhm.
first year of the first 6 months of this year, of 2025. Are the big players still serving to lift the overall market, or are investors gravitating to specific industries within tech now?
So when you look at indices on a cap weighted basis, we definitely need mega cap names to maintain their anchoring of this trend. So we need those to keep working if the indices are not going to falter. I would point out that the technology sector is, or growth equities has a lot more diversification than what most people think about. Most people look at Nvidia or just semiconductors as an industry group. And I think it's worth noting that there is a major change of character for individual names like Nvidia. We've had weaker and weaker momentum readings since the June highs. All of the moving averages that we're holding in each pullback are now broken. In my own trend model, it's in a no-go configuration right now. It's having a little bit of a retest, a counter trend rally when we're talking about a daily basis of that chart. So there's certainly some stretched trends that are now looking a bit toppy. So when we think about seasonality headwinds that might be coming in September and October, I think there could be a lot of rotation happening. So money coming out of some of those big names that served investors so well during this last rally. And maybe they'll be looking for other opportunities, perhaps things at slightly lower valuations or more attractive from a technical setup as well.
That actually sounds quite positive when you're not relying on that single name.
Mhm.
Growth or value, which is currently looking healthier?
Growth still leads. And so in all of our relative strength work, you'd see growth across all categories outperforming value. But that gap has narrowed on those falling yields and broader participation, things like healthcare and materials outperformance in August that hints at a little more balanced market rather than a wholesale regime change. It's not a tech is done and we're going straight back into materials, building supplies and infrastructure. So I wouldn't say that it is a regime shift, but perhaps a more balanced market. What we'll be watching is real yields keep trending lower. That supports growth and growth equities that have a duration premium. If it's steepening, driven by improving activity, then you'll see value cyclical sectors start to come back into leadership positions and outperform on a relative strength basis.
So large cap or small cap? I can't quite get my head around why small caps are having a hard time keeping up.
Yeah, they did have a strong August, but they're struggling to keep that follow through as we get into September. So they're lagging again. I know we've been talking for the technical analysis community has been talking for 18 months, 2 years about when is the heyday for the small caps? When are we going to see this massive catch up for all of those Russell 2000, Russell 3000 names? I think debt loads and sensitivity to growth have been keeping a lid on that momentum. The valuations are really compelling. So to each investor, you got to follow your process and know your own stripes. But right now we're still seeing large caps continue to lead. I think the trigger for a durable small cap run is going to be clearer evidence and some reacceleration for easier financial conditions. So we need lower short rates, looser credit. I think it really comes down to liquidity.
Probably a flattening of the yield curve.
Yes.
Yep. Any red flags that you're seeing that might prompt you to just raise a word of caution across the stock market?
Yeah. On the broad context of how is the market doing, I think breadth measures are critically important. A couple of good friends of mine and fellow CMTs just wrote a white paper recently where breadth can be a really good bellwether, the canary in the coal mine ahead of drops in the indices. When you see you want to have a deep bench strength in a market rally is important because you got to be able to pass the ball and see that healthy rotation. Ralph Acampora always said, rotation is the lifeblood of bull markets. And when you have very narrow leadership, then you're just on much weaker footing in those index level rallies because we were just talking about a few mega cap names. The other thing that, and I hate to be outside my technical expertise, but I think earnings leadership fatigue it could be a problem, right? The whole AI complex, the expectation of what those firms are going to be able to achieve is it's meteoric. Broadcom's beat was certainly helpful, but a reversal in those earnings releases could mean that some of that outsized sentiment for the AI complex gets a bit of a reversal.
What does the commodity world look like to you at the minute? Lumber's hit its lowest point year to date, hasn't it?
Yes, down about 20% since early August. Lumber is certainly signaling a softer housing demand, tighter
Right.
construction margins. It is a good barometer for the real economy, and that is certainly flashing caution. But I love the commodities complex, even though the data is hard to pin down sometimes. When you see a crisis happening in equities, there's usually some alpha to be captured in the commodity space. So gold, we're at 3,550 to 3,600 an ounce. Every technician in the world looked at the big broadening cup and handle formation a la William O'Neill methodologies. And once we broke above that 2000 level, after testing it 12 times, it was off to the races. And that really sticks to some of our principles, that when there is no resistance level above a major breakout, when you're at all-time highs, there aren't other sellers up there sitting ready to sell. And certainly we know central banks have been pretty voracious buyers.
On the sector level, back into the stock market, are there some that are really appealing and some that you think are likely to lag from here, Tyler?
I still like semiconductors. I'm just a helpless trend follower. And until it is not trending higher, you got to stick with what's working. And certainly beyond some higher volatility, seasonality in September and October, I think we could see really strong rallies through the end of the year. They have pretty resilient uptrends when you get into the individual names. And from a contrarian point of view, I don't know how often you dig into the industry groups in the healthcare sector, but biotech and pharma have both made a really nice basing patterns, had some breakouts in August, and their very deep underperformance certainly makes them a strong value play. Value investments turn into something that trend followers really love once they break out and they start working. So those are some things I'm keeping an eye on. Certainly materials and industrials. If the tape is broadening in this way and there's potential for a reacceleration of those August leaders, right? If the new regime continues, then I'm paying attention to those as well.
Very good. So what's next for the CMT? Are you going globetrotting anytime soon?
Yeah, despite my spine surgeon's best pleas to keep me out of long haul flights, the CMT Association is hosting our 2025 Global Investment Conference in Dubai. That'll be September 30th through October 2nd. It's getting chilly upstate New York, which means I need it to be 105 degrees in the shade, and I'm headed to Dubai to get that done. But yeah, it's going to be a great global gathering. We've got folks coming over from Singapore and Hong Kong and all of Latin America. And I think the third runway at Heathrow is now being built in Abu Dhabi. Like half of Britain lives in the UAE now. So it's a very dynamic place, perhaps like New York City was in the 1920s. It's just a really, really dynamic environment.
Brilliant. Tyler, thank you for joining me, and the best of luck with the travel plans and with the conference at the end of the month.
Thanks so much, Andrew. Great to see you, and I'll talk soon.
All right. And don't forget, to the audience, if you like today's episode, remember to subscribe wherever you download your podcast from. Thanks, Tyler.
Thanks, Andrew.
Bye for now, everybody.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.